Welcome back. You're still tuning Inside Out on CNBC-TV18. This is our Swotlight segment. And with air travel coming back with a bang in India, I thought of looking at some of the segments or sectors which are ancillary to this sector. And with increasing usage of airport lounges, DreamFolks came on my radar. Listed in September 2022 with a 55% premium to its issue price of $326, the company is an airport service aggregator and provides airport-related services such as lounges, F&B, spas, meet and assist and nap rooms and hotels for transit. In FY22, company had 95 to 97% share in the India-issued card-based access to domestic lounges and 68% market share of all the lounges in the country. Let's explain this via the domestic lounge market. Now, travelers can access lounges via loyalty program cards, which is around 5%. There would be digital or QR codes. 6% of them do walk-ins. Airline voucher is around 3%, and rest do it via credit or debit cards, which is a whopping 82% of the total access market. Of this 82%, DreamFolks has a market share of 95 to 97%. Now, let's understand the value chain of the lounge market. DreamFolks would have three types of clients. One would be the credit card company itself, something like Rupee or Diners Club. Second would be the banks who are the card issuers, something like Axis Bank, Bank of Baroda, HDFC Bank, ICICI Bank. Then you would have the corporate clients. There would be Indigo, Ease My Trip, Club Mahindra, to name a few. Now, these corporates, they tie up with DreamFolks, where DreamFolks issues cards or vouchers, gives app access to customers on clients' behalf, and this is via a hybrid model. And access is given to multiple services like lounge access, meet and assist, and the others which are mentioned here. Now, they have an asset-light model with minimal incremental capex needed to be deployed by the company regularly. This allows for high operating leverage. The major costs would be employee costs, of course, but that is around 4.9% of revenues on an average basis last few years. And technology costs are important as well, but they have been around 0.4% of the total revenues. Now, a quick look at the financials. FY20 and FY21 revenues, they were hit by COVID. FY22 did see some recovery, and then there was a big jump in FY23 to 773 crore rupees. Margins too haven't gotten back to those levels of 18%, but they have been between 16 to 17% in last 2 to 3 years, and they reported a loss in FY21, but this is after profits of 32 crores in FY20. From there, their profits have increased substantially, currently tracking 72 crores. But important to note, the revenue number, this is the deemed revenue, that is the value of service they provide to the client, but the actual revenues, they are only the commissions they earn from clients. Hence, the important metric to look at is the gross profit earned per customer. That was at around 137 rupees in FY20, then it saw a fall to 129 rupees in FY21 and FY22, and in FY23 there was a big jump to 156 rupees. Whether they can continue this or not is the key to track. Now, with every business there are some risks as well. The revenues and profits for DreamFolks are dependent on air travel growth. If passengers reduce, this would hit their revenues. Also, with rising fares, this number is key to track. There have also been talks of reductions in MDR rates, which is a rate charged by card issuing companies every transaction with a debit or credit card. If this is implemented, it could hamper DreamFolks' profitability, as their clients might reduce spends on cashbacks and promotional benefits on cards. So that is a possible risk. In terms of shareholding, promoters hold 67% stake, mutual funds at 7%, and some notable AIFs and FPIs also hold stake in the stock. Okay, that was our Swotlight segment, but now we have run out of time on this episode of Inside Out. It's a goodbye from Nigel and I. But do write to us and tell us the companies you want us to discuss and you want to hear about, and we'll feature these on our show. Thanks a lot for watching.